Hello, everyone. Sorry for the delay. We have a little bit of technical difficulties here. Thank you very much today for joining Xilva's webinar, Managing NbS Risk from Investment Decision to Project Performance. Today, we have a panel of speakers who are leaders in sustainable and NbS carbon finance, and we promise to make this session informative and interactive. So we are leaving 15 minutes at the end for Q&A, so feel free to submit your questions in the Q&A box. The webinar will be moderated by Xilva CEO, Tim. I'll let Tim introduce our speakers. Over to you, Tim.
Thank you, Ling. So I would like to go with a panelist introduction first. So the first one is Shauna Matkovich, and she is a self-described risks junkie, which is an interesting description when you realize she's a forester, actually. She studied in British Columbia and then worked as an operational forester there. She then moved to International Woodland Company, a very large Danish forest investor and operator, and being active there both in investment management and in the sustainability area. In 2021, she set up her own company, the Forest Link, advising investors on understanding the asset class, building their own forest portfolio, and of course also on managing risks. She's also a podcast host with the podcast Forest Invest. That one I can highly recommend. So I'm a very regular listener on that. So very highly recommended to subscribe and listen to Forest Invest. That's then the second speaker, that's Shauna. The second speaker is Chris Zink. He joined the energy and carbon markets early in 2008, right after his master's in international affairs at Columbia University. He was with Eneco, an energy and carbon trading firm in the Netherlands for 4 years, and then joined the Swedish Energy Agency with a variety of responsibilities around the carbon markets, including representing Sweden in the TCAF, in the CPF, and in Article 6 implementation. Since 2021, he is with Conservation International, creating, building, and managing their portfolio of carbon investments. And he's also a part of the ICVCM, the Integrity Council for the Voluntary Carbon Markets, specifically working on benefit sharing there. I'm the CEO and co-founder of Xilva. We provide due diligence services to forest and nature investors. And besides our investment methodology, Xilva Grade, we've just recently launched a product called Xilva Monitor to understand, manage, and mitigate risks along the entire forest and nature investment cycle. So we are also waiting still for David Tenkode. So I think he has some technical difficulties. That was the reason why we started a bit later. But my suggestion is we just dive in and I introduce him not in the blind, but rather when he actually comes and joins us. So I would like to start actually with understanding how you see risk management along the investment life cycle and understand basically what is happening before the investment decision and what is happening after. And that means during the disbursement phase of the investment and also after while the investment is running. And I would like to ask you, Chris, to start and take us through the investment process you follow at CI, how you look at risk management specifically, and how that view of risks evolves over time in the life cycle of an investment project.
Great. Thanks, Tim. Thanks for the opportunity to have this conversation. So yeah, like you mentioned, I work for Conservation International. We're a environmental NGO. We have offices in 30 countries around the world. We were founded almost 40 years ago, and we've been a leader in nature finance, innovative nature finance, essentially since our inception. We did one of the first debt for nature swaps in Bolivia in the late 1980s. Our mission as an organization is focused on nature for people. So within the carbon market context, that means our role in the carbon market as a not-for-profit NGO is to support the growth of a high quality, high integrity, nature-based carbon market. And why are we doing this? The science tells us that nature restoration, protection, and improved forest management, altogether known as natural climate solutions, has the potential to provide about a third of the mitigation needed to meet the goals of the Paris Agreement. And yet, right now, NCS, natural climate solutions, still only receive less than 5% of total global climate finance, right? So this is the problem, and we're sort of working with many others on the solutions to driving that needed finance into nature. So, that sort of project, that larger project of driving finance into nature is really how to make nature, an asset class. So we talk a lot about making nature an asset class at Conservation International or CI. Carbon markets are one of the sort of clearest and most direct ways to do this. So we want to see a thriving, high quality, high integrity carbon market, which supports the rights of local people and indigenous communities. So we do this by playing in the sort of the full value chain of the market. Firstly, by partnering with project developers and financiers to drive finance and sort of high quality best practices into the early stages of project design and development. For example, things like benefit sharing best practices, how to do stakeholder consultations, and FPIC, free, prior, and informed consent, which incidentally is not something that only happens at the beginning and kind of like design stage of projects. It's something that has to be done really throughout the life of an activity, which, as many know, can go out for decades. Geospatial analysis. So we have a sort of world-class GIS team, and then state-of-the-art project management. On the finance side, we're very fortunate to have a philanthropically funded nature-based carbon market facility called Broadleaf. With Broadleaf, we can provide early stage projects with recoverable grants or concessional loans to get projects kind of in investment ready for private sector investors. We can then support those projects with matchmaking on private or public finance. We're also, so I said we're full value chain. And so what that means for us is that we're also involved on the credit sales side. So we have a sales desk and we sell credits from our projects on behalf of our project developer partners to high quality and buyers. So that's kind of like our end-to-end process in terms of risk management. And kind of back to your question, Tim, we have a number of tools that we use on the carbon accounting and GIS side. Most of those we've developed in-house. Some of them we've developed together with partners. We look at all the key risks, counterparty risk, country and policy risk, reputational risk, environmental integrity, and social community risks. All of the, of course, financial and market risks, many of which we're not able to control. So there's categories of risks that we're able to work on and control ourselves, and other things that are a bit sort of outside of our direct control. And then lastly, implementation and delivery risks. So we rate projects essentially across these broad categories, both at the very early and design phase, and then throughout the life of the activity. And this sort of continues on even during implementation. We do most of this in-house, but as mentioned, we do work with some third-party software tools and vendors. By the time we're engaging with buyers, we do want to be in a place where we feel we have a handle on all of the major risk categories, and where we can comfortably say that we understand them, and the ones that are mitigable by us, that we have those mitigation pathways sort of appropriately figured out.
And that continues also when the project is already fully running and producing carbon credits and being developed in an ongoing way. You still apply this process.
Exactly.
Yeah, very good. Thank you. So I want to continue with Shauna, and then I'll introduce you, David, promise, after Shauna went. So Shauna, you're well versed with investment processes in NbS, but also in traditional timber-focused forestry. So an industry that's very old, that's been, for example, manifested in TIMOs and timber management organizations. So supposedly that's something where we can learn from, because they've been doing it for a long time. How do they handle risks, and is there anything we can learn from their approach and mindset?
Yeah, thanks, Tim. And thank you also, Chris, for your insights. Really good to see how Conservation International is addressing this. I think, from the timberland side, it's important to remember that different stakeholders and different investors view risks in different ways. And in traditional timberland investments, we need to remember that we're often working with institutional investors' capital. And I don't want to say uniquely, but a very important feature of these investors is that they have a regulated fiduciary responsibility to their beneficiaries. So for them, financial risk is paramount. And so when they're looking at an opportunity, they're looking at the return potential, but equally as well, they're looking at the risk of losing everything or losing a portion of basically their beneficiaries' capital. So it's also a sliding scale, because you might have a pension fund that's investing in yellow pine plantations in the southern eastern US. And you might have a development finance institution that's investing into pine plantations in East Africa. But, very different risk return profile, lower risk, lower return in the US, higher risk, higher return in East Africa. But regardless of the sliding scale, risks tend to be very well managed on the timberland side. They are, so first of all, at the strategy level, when a TIMO or a timberland investment management organization is putting together a strategy for how they're going to invest, risk is brought in right at the beginning. So, and this basically first shows up in screening opportunities. At the very highest level, it's which countries are we going to look at? Which species are we going to look at? Which end markets are we going to look at? So those being objectives, but then looking at the risks to meeting those objectives. And I want to get back to that maybe later on in the discussion. But so it's the screening, and then it goes into due diligence, where again, the investment manager will have a very detailed due diligence, whatever they want to call it, a checklist, a questionnaire that they develop, and they assess these opportunities against. And as Chris kind of alluded to, looking at different sides of it. So financial risk, market risk, currency risk, legal risk, physical risk, manager risk, ESG risk. And these, again, I'll get into it later, but this, looking at how I like to see it at least, is a risk category. So when looking at the risk event that could take place, not necessarily the impact or outcome. And so with that, you have the due diligence, and then you have, let's say, decision to invest. Now, how you're going to mitigate that, or how you can mitigate it in the first instance, and how is often done, is through terms and conditions for following through with this transaction. So with the deal proponent or the operator who's going to be carrying out forest management on your property, you will have different, this has to be in place before we sign, or this has to be in place within the first 3 months or the first 3 years of having invested. And then you can set up remuneration bonuses and things like that based on meeting these risk reduction measures as an incentive. So we have the screening, the due diligence, we have the negotiation into terms and conditions of the deal, and then we move into the onboarding and carrying out those early risk reduction. Then there's the regular monitoring. So we have, often common is monthly operational and financial reporting. So where the operator on the ground will be monitoring against predefined targets. So for forest operations, that might be your planting targets, your thinning targets, or what have you. For your financial, it'll be, looking at your budget compared to what your actual expenditure was, or revenue generation. And in both cases, with the operational and financial, comparing when you look at your target compared to your actual performance, then explaining any variances. So, and this will help kind of realize risks that might slowly be dripping in over time, or might, be very evident in one fell swoop in one report. And then there's also ESG risk, which can either be blended in or be separate. And then often what I see is an additional risk and performance review that may come in, semi-annually, annually, maybe less often, maybe every few years. And this is often, it depends how it's structured, because if it's a compliance review as part of the legal financial requirements, it will have to be within a certain period of time, but it could take a different structure. And basically what this does is it brings in another set of eyes from the regular day-to-day operations, so that basically it takes away that user bias of having the day-to-day team that, for one, they might just be blind to a risk that they're seeing it slowly change over time. I mean, as you watch your kids grow, it's hard to see, you know, from day to day how they're growing. But if you look back on a picture from 3 years ago, you're like, oh my God. So it's kind of the same thing. If you're with a project day in and day out, you can lose sight of these small things. Whereas if you bring in a third set of eyes, they have that extra advantage of not seeing things on the day-to-day, and maybe having that bit of objectivity of not being so close to the people that are involved. So I think I'll stop there, and just to say, I think there's a lot to be learned actually from both sides. I think the NbS side has a lot to teach to the TIMO side as well.
Yeah, thank you. So I want to bring David into the conversation and also do the proper introduction of him. So he has a background in business and economics and started his career in telecoms and IT. And he then joined renewable energy financing, where he spent some time at KeyBank and Oiko Credits. After a stint at South Pole, running investments there, he has moved to Triodos Bank in the Netherlands, where he's responsible for investment at the Triodos Regenerative Money Center, where they finance visionary early-stage projects with investments, donations, and loans. In the pre-conversation, he mentioned that he's considering himself bruised and battered by the carbon markets, but not giving up. We're curious to hear what that experience translates into when talking about risk management. And very concretely, I think it's interesting to learn from you and draw on your experience both at Triodos and previously in renewable energy. Anything to learn from a process a bank has in place, and anything from the renewable energy space that we can learn of in the NbS space?
Yes, thanks very much, Tim, and hello everybody. I'm sorry for being late, and actually we have some things in place at a bank that precluded me from installing the Zoom app. So therefore it took me a bit longer before figuring out that I actually can join by the browser. But so Triodos is a regulated bank, and we are, I think, a bit of a special bank in the sense that our money is really to change the society, change the lives of people for the better, and also make a decent return. But you can call it impact financing, but it was actually done by Triodos Bank from the early 80s, before that impact financing was actually a word. Triodos Bank as such has also been one of the first to invest in renewable energy, wind projects, before any other institutional investor would even touch it. And the team that I work for in Triodos is called Triodos Regenerative Money Center. It's a bit special. It's the freed up capital that Triodos has, and that we invest in nature restoration and the transition of the food system. And those two often overlap. And of course, if you talk about nature restoration, then one way to make this financeable is through credits, carbon credits, nature credits. We have already some in our portfolio. One is actually with EVA. That's an organization that developed the Klimawaldstandard. For those of you who don't speak German, that is the German forestry standard, and that's a new standard specifically for the types of forests that show up in your background. The other investments we have is with Treevive, maybe also a known entity to you, a company that is an early stage developer of reforestation and REDD+ projects in the global south. What my background is, and maybe commenting on what the introduction was by Tim of bruised and battered by the carbon markets. Before joining Triodos, I joined about a year ago. I worked for South Pole to make investments from the balance sheet of South Pole, and South Pole, there are a lot of good people working there, a lot of good things accomplished, but also it was also, I think, the accumulation of what's really can go wrong in the carbon in the voluntary carbon market. And I think we all have seen some of these publications and around what happened. But I think if you have to distill it, there were two problems there with this very large project in Zimbabwe, which kind of was, I think, one of the reasons why the VCM imploded a few years ago. And there, the one issue was about the legitimacy of the carbon credits themselves, right? Discussions around baseline, and that's always, I think, difficult if you talk about avoidance credits. But that's more of a technical debate. There's many viewpoints on that. And the other part of the issue there was, and I think it was more toxic, was about cash. Where does the money flow? And then maybe also making the connection to what we talk about here today about risks and risk mitigations. I think truly the risks, what caused the risk there was having not understanding what was happening on the ground, not having a true connection of with the communities there that were supposed to be paid for the measures that should avoid the deforestation. And so I'm going to make a bit of a one-liner here, but I think there is, if you look about risk management, there's no substitute for local presence. I mean, you can have all the smart tools in the world, you can have all the, the Excel sheets and the risk mitigants and all your tables and, reports. But if you're not there, if you don't have a real connection, if you don't have people on staff that are on the ground or actually work with partners that have a real local presence, you are going to run in trouble. That is just basically what my lessons learned are. It's not also just coming from this pretty short stint at South Pole. It's also before, and I think I failed to mention it, but I have this background in renewable energy. Tim, I think you mentioned it, right? So, and there are definitely some similarities, and I think I can touch upon those, or want me to address those later. Tim, I'm back to you.
No, actually, I would love to hear a bit what we can learn from the renewable energy space specifically. I think it's, it's just a bit older than NbS, or it scaled a bit earlier than NbS. So it would be great to learn from that. Yeah.
Yeah, and I thought about this, and there are of course huge differences, right? And I think I already mentioned one of them. I mean, it's always easier to sell a kilowatt hour of power than a carbon credit, at least in today's market. But there are also, I think, real lessons to learn or similarities. And so what I'm going to do, I'm going to sidestep a little bit like the more technical or theoretical approach, and basically give you some, lessons learned from the reality of doing these projects in sometimes very difficult areas and jurisdictions. And one of them, you learn the most from your biggest mistakes, right? And the one was with a hydropower project in Peru that really went belly up. And when I worked for Oiko Credit, I worked there for 8 years, which was a true impact investor in Global South. I think what it was, again, like not having the real understanding the real local context. And I think we ignored some of these telltales. And I'll give you a little story here if you allow me. But what happened, we were looking at this possible investment. It would have been a 5 million for our part in the equity side. The total project was about 100 million, so it's a big project. And then I get a call from the project sponsor who was there on the site in Peru. And he said, and we talked about environmental impact assessment and everything. And then he gave me a call and he said, well, David, there's really no need for an environmental impact assessment because I'm standing here at this river and I see no fish. And I thought he was joking, right? But it's just like, this was a guy who lived in Spain. He was developing a project in Peru, and he had just absolutely no clue of what it took to really, develop a project in the local context. So that should have been my first telltale of like, let's get the hell out of here. But anyway, ultimately, they did get their environmental impact assessment report, but there were other things that happened to make this project fail, but it just showed if you don't have somebody, a project sponsor, who is there on the ground, and I'm sorry if I keep making the same point again, but then, yeah, chances are you're going to run into trouble. Another lesson learned, maybe I'll share with you, is also to keep your critics close. And I think that's important. We also saw that happening with South Pole. I think the South Pole response to what happened in this specific project was wrong, and basically push your critics out and say, you don't understand the carbon markets. We had similar instances also when I worked for Oiko Credit in another hydropower project. It was in Guatemala, where there was a local NGO who really picked up on some social issues. And I think there we approached it differently. We basically embraced them and saying, hey, great, there are probably some blind spots for us that we haven't seen and that NGO has picked up upon. So we worked with the NGO to try to solve these issues. So I think it's also, just a lesson learned was for me, like there are critics and sometimes, it's not the kind of comments you've spent all this time and money on this project, and then some NGO stands up like, hey, and there could be the inclination to push them aside, but I would say do the contrary, do the opposite, and keep them close. Okay. I have a few more, Tim, but I also want to be like not taking the whole stage here for everybody. So
no, but very, very interesting and very, very helpful, and I think very good and concrete learnings for running NbS risk management.
Yeah.
Chris, maybe a question to Chris while we are moving on. You partner a lot with other players, so for example investors, but also other entities. Any learning on how to collaborate in risk management and risk mitigation among co-investors and other implementation partners? How does that work in your world, and what would you recommend for others to do?
Great, thanks for that question, Tim. But first, I want to say, thanks for your contributions, David. I quite like Triodos Bank and the mission, and I think if you've been in the carbon markets long enough, you've absolutely been bruised and battered at one point or another. So I share that experience. And your point about where does the money flow is just super important to kind of always have in mind. In the kinds of projects that we're involved in, it's maximizing revenue to communities, I think is one of the absolute critical tenets that we try to always ensure is part of the financial models and the design of every single project, right? And that's hard to do when you're balancing a lot of different sort of stakeholder interests. It's not necessarily straightforward, and sometimes it means trade-offs. So that's something to be considered. But sort of like the successfully doing that is I think often make or break for a project, right? If you're not able to really show and bring community members on board with the idea that they are receiving a fair portion of the revenue, and that they're deeply involved in the decision making going forward in the project. I think that's all very critical. So back to your question, Tim. I think we're in kind of a unique position in the market because we have this sort of pot of scarce philanthropic resources that we can use to deploy into high impact projects. So we can sit between the investor, the project developer, the buyer, and community members, and we see ourselves as kind of agnostic between these different stakeholders. We want everyone to kind of succeed here, and each stakeholder has an important part to play. Where the tension sometimes lies is that we are probably closest aligned with communities, right? And so in the old days of the clean development mechanism, the CDM, which I'll acknowledge had its own set of problems, buyers generally took on a good deal of that delivery risk, meaning that if the project developer did everything in its power to ensure delivery on time, but factors outside of its control led to delays or under delivery, this is something that the buyer would generally accept, and there would be sort of provisions in contracts to allow for additional time or some level of flexibility. Now, and I know this because I was on the buy side of these transactions for the first 15 years of my career. Now, the trend in the current market and in recent years is that many of the buyers, they really want to put that delivery risk onto the project developer, and in a way, if it is a community-based project, therefore sort of onto the folks living in the landscape. And for some kinds of projects that don't involve communities, this is probably fine. Let's say you have a large project developer and they focus on, let's say, landfill gas projects, and they can easily switch out credits from one landfill gas to another. I think that's probably fine to kind of push that delivery risk over, and you're pricing things accordingly. But if you're looking at large scale restoration or protection projects, which are really the kinds of projects that I think a lot of us really want to be doing, and it's certainly why I'm in the carbon market. It's asymmetrical, right? For let's say a large multinational to put all the delivery risk onto a project developer and local community. Some of these project developers, they may only have like 2 or 3 projects, and so they don't have the possibility, if something outside of their control happens and there's a delivery delay, to just sort of grab credits from another project in a large, let's say, portfolio that they might have. So yeah. I've seen this. Yeah, go ahead, Tim.
No, sorry, go ahead.
So we've seen this, in a number of ways kind of play out over the last couple of years due to market dynamics, and I do think it needs to be addressed. And if we don't, I don't think we're going to really see the growth of this sector, the nature, the community focused side of the nature-based carbon market.
Yeah, there is actually a question on this in the chat. So I've been watching the questions come in the chat, and maybe that's the right point here to bring it in. Who says, or the anonymous attendee says, can the panelists speak to ownership of risk? For example, an early stage carbon project is common for delivery risk to be fully on the shoulders of the project developer. And in some cases, that accountability is even pushed further upstream to landowner community farmers. How do other sectors manage this? Who owns which risk in e.g. solar investment, timberland investment? So is there examples on how to deal with this in other, either timberland investors, maybe not so much because they tend to own the properties. But anything from the renewable energy space there, where that can be brought in, or external risk providers such as insurance, is that something that's working already in your experience, already seen in the wild, or just as a concept as of yet?
Happy to hand it to David or someone else who's actively sort of in the renewable space right now.
Yeah, I think I'm not sure if what is common practice in the renewable energy space would apply here, but if you build a solar power plant or a wind power plant, then typically you would put that on the developer. You would have a project completion guarantee, and that would then also be taken partially on by the construction company. There would be a conglomerate of companies that are building and seeing it through to completion, and so typically the one with the deepest pockets in that conglomerate would take on that guarantee. And so, yeah, again, I don't think there's any. I don't have like a good answer there for what could be used in the setting of carbon development projects, to be honest. So
there's often a comparison between sort of nature-based carbon projects and renewables, and sort of the sentiment, what we've been able to do in renewables markets, we should be able to do in nature-based markets, right? And I think that's true for some categories of things, but then it's just not true for others. And I think this is one of those areas where it's not true. You just don't have the same kinds of features in a sort of capital stack of a nature-based carbon project that you do in a large-scale renewable energy project. And I think that's the kind of thing that we need to a little bit rid ourselves of that sort of illusion that they're going to sort of be like for like these kinds of ways of financing.
So there has to be awareness and willingness to distribute the risk to the ones with the deepest pocket in the capital stack. Basically, that's could be the approach, and that can be a large project developer in some cases, or if it's a pure community project, even the buyer has to take some of the delivery risk, and factor that into their investment or their offtake agreement. Yeah. While we're at audience questions, I have another one. The need and use of due diligence in other more mature sectors is clear. None would think about going into a big real estate deal without having undertaken a robust DD, regardless of being rated highly or having an energy certificate in place. Do you think it is so clearly understood in NbS already, or is the role of certification or ratings confused with what DD does? So the question is, what does DD do for risk management? What does certification do for risk management? What does a rating do for risk management? I don't know. I saw Shauna unmute, so you want to take it? Yeah.
Yeah, I was just thinking, I mean, to be honest, ratings, I don't see it happening in forest investment so much.
Okay.
And the due diligence is absolutely necessary, I would say. And it seems it's also quite a small niche, competitive, boutique industry where everyone keeps their secrets and processes close to them. So I would also say that relying on ratings is maybe at least this is what I'm seeing, is we're getting closer to the projects and the developers and things like that now. Relying on ratings is just like further than arm's length distance between the investor and the developer. So I believe more in kind of getting closer to the project and understanding your proponent in a more personal way.
Okay. Yes.
Can I add to that? Yeah, I mean, I basically fully agree with you, Shauna. I think ratings have a role in the ratings agencies have a role in the market. I think they're needed. It's part of getting to a mature marketplace. And at the same time, kind of following on some of the comments David made, you don't have the ratings agencies going and visiting projects on the ground, right? And if you're not on the ground in a community base, especially, but any kind of, I think, nature carbon activity, you don't have full information. You don't really know. I mean, when we visit projects, sometimes we're looking at projects for a few months and having lots of conversations over Zoom, and then we visit the project, and it's always sort of like incredibly illuminating. You learn sort of a huge amount, and sometimes that's on the positive side, and sometimes it's on the negative side. It's always complex. So I think for this category of project types, and sometimes we see this in the ratings that come out. There are things that you can see from a satellite, and then there's other things that you'll never be able to see from a satellite or a drone, and you really have to be on the ground.
I have to say, and I concur with the person who asked the question, that we do see that confusion a lot. I mean, we are a due diligence provider, and we often get asked by not so experienced people, but also by more experienced people, what is the difference between you and a rating, which is a fair question. We can explain it very well, but it's still, I would say, a difference that is not so clearly obvious to everyone. So we try to make that more visible as well, but there is definitely some confusion there. So thank you for the question, anonymous attendee. Then while we're here, I have another one. Are risk ledgers a common tool used in other sectors? It's something, for example, we base our approach on. Could the panelists offer examples of red flag risks that would be raised in other sectors? So basically building it about a ledger of core risks that are then followed up over a longer period of time. Is that something that is common in other sectors that you are experienced in? I don't know who wants to go.
I mean, I could just speak to the timber side,
Mhm.
and I would say yes, and I would say it's a long list, and there's some that are going to be repetitive over every different asset that you're looking at, regardless of where you are in the world. Like the top 10-year security, is first and foremost. Biological growth and the yield data and the ability to grow the trees that you're planning to grow. And this is important for whether you're looking for carbon objectives or for timber objectives. You want to generate that timber or carbon. You want your models to show what you expect. Markets, market prices, demand. So there's certain characteristics that, we could spend all afternoon going through the list. And then there's context specific ones, so if you're working in a certain country where it's more common to lease land or work with communities than to buy land freehold, then you're going to have a different set of risks. So it's, and the ledger itself, yes, absolutely. Yeah.
Yeah. So we have one question here on agroforestry. So basically, and asked by Rijul, who says, Rijul says most NbS investment discussions I've seen focus on forest restoration projects from a due diligence and risk management perspective. How would you approach agroforestry projects differently, given the multiple co-benefits like crop yields, livelihoods, and biodiversity, in addition to carbon sequestration? And I can take that because we look at a lot of agroforestry projects. We actually see them very positively as a stabilizing element that you specifically create livelihoods and with that friends on the ground for the project. So we see that as a very, very good tool if it's possible and feasible in the ecological context and in the sort of crop context. And of course, there you come to the limits absolutely of satellite analysis. So you definitely have to go talk to the people, see if the systems work on a very small level also. Yeah, you definitely have to look under the canopy basically to understand what's going on. Any other comments specifically on agroforestry, maybe from Chris?
Sure, I can take it. Yeah, we're working with a large NGO that's present all over, especially Africa, on small scale agroforestry. I think the nut to crack with carbon agroforestry activities, especially if you're dealing with sort of small scale rural stakeholders, is that these are extremely low margin projects. And so right now, what we're seeing is that without some sort of philanthropy upfront or very highly concessional finance, they're extremely difficult to get off the ground. I think that's been the case for a lot of these sort of like niche activity types over the years. Once proven out, it's easier to get that kind of finance and it's easier to sort of achieve scale. But yeah, they need to be quite large, over for example an entire country in order to actually achieve a successful at least theoretical financial model, and then we're going to see how it goes over the coming decades. But we're hopeful with a couple of models that it will work.
Yeah, we do see actually quite successful approaches in insetting. One of the largest players in that, for example, is Nestle, who have a global reforestation program with a commitment to plant and grow and keep more than 200 million trees by 2030. So pretty large commitment. And a lot of that is delivered actually through agroforestry, because there you can actually integrate it very nicely with the supply chain and work with existing farmers you have for the commodities. And it's also commodities where it's very working quite well with coffee and cocoa. So you can do a lot there with agroforestry and provide additional benefits actually to the farmers you work with anyway, and make your supply chain better essentially. So good. I have two questions on Partnerships with CI. So one question on how to initiate collaborative partnerships. Maybe Chris, you can answer it directly in the chat, so we don't spell email addresses here, or you can just send a link to a proper place to go to. And then another one on a tool for open forests, which we know also quite well, for impact monitoring frameworks. Also a contact there in the chat. There is one that you wanted to take, I think, Chris, on insurance. Actually, two questions on role of risk of insurance and risk mitigation for NbS projects. And is it the missing ingredient is another question for the buyer. We do see, for example, we work for Symbiosis Coalition, the joint advanced market commitment by Google, Salesforce, Meta, Microsoft, and McKinsey, and they have insurance in their RFP. So basically, because it's an offtake model, so it's not delivered on spot. So there is a delivery risk involved, and they ask for insurance as part of the RFP, for example. I don't know, Chris, what is your experience there?
So my quick point on this is just that it is necessary. We do need it for a mature market. Right now, most of the products that are available come in quite late, and they're for a very short period of time. So and that has its use, but for projects that have a quite long scale up period, which is the case for most community scale activities, where you have things like FPIC, free prior and informed consent, and if you're doing that properly, that can take quite a long time, right? Maybe 1-2 years of discussions with community members before you really gotten to the point where you have true buy-in and you're sort of marching along together with a sort of co-design process. You don't have a lot of insurance products that are available pre-registration, right? So I think that's and there's quite a lot that can happen, and that often you need to have investment during that pre-registration phase. And so if you have investment but you don't have the insurance product, then that's sort of it's a mismatch, and I think that's what we're hoping to see. And of course, the insurance product has to be something that's reasonably priced as well, right? So it can't be sort of prohibitively expensive.
Yep. So then a question to the risk junkie, Shauna. How are risks managed and monitored differently between investors and project financiers versus off-takers? So is there any difference you see there between those two groups, how they approach risk, how they manage risk, how they mitigate risk, how they contribute to the mitigation of risk?
Yeah, it's a very good question. And I think when we're working with blended timber and nature-based solution strategies, we have to think about the different profiles of these parties and what their objectives are that they're bringing to the table. So the institutional investor may be concerned with any risk that is going to affect their financial return, where a carbon investor may be concerned with, or an off-taker, with what is going to affect their credit delivery or their reputation. I mean, you add to the mix the community complexity, and maybe they have a vocal NGO like CI that is, representing them, and they want to make sure that there's no risk of violating community rights. And I've seen this in a real timberland due diligence process where I was looking at the ESG, and it was in an indigenous area, and I was reviewing the ESG risk assessment that was done by the operator, and they only looked at it from the point of view of financial outcome. So yes, they looked at indigenous and FPIC and what have you, but they only looked at it from the point of view of risk to delivering the financial outcomes of the project. They didn't look at it from the outcome of their project on the indigenous people. So I think it's very important to think about these types of engagements and partnerships when you have very different objectives in mind, what the risk actually is, first, for starters, because I think we talk a lot about risk, but it's the risk of what? There's a risk event, which by and of itself, you know, what's the importance of it? It's what it does to us meeting our objective is what matters. And so you think about the off-taker's objective and the investor's objective and the community's objective. We need to consider that risk and what it means for the different parties. And I like to think of this common example of fire. So fire is, you know, a risk event. It's not the outcome itself, but the institutional investor would consider the impact of fire and damaging the forest assets. So their mitigation is going to be to put resources into fire prevention and suppression across the forest assets. They might not be thinking anything about communities in this regard, or reputation. The carbon investor would be concerned about delivery of their credits. So if there's a fire, they're not going to have that delivery. But of course, like you mentioned, Chris, we get into then maybe having insurance or buffer pools. So maybe they're equally or more concerned about reputational risk and having their headlines in the papers about supporting a fire that, or a project that's just resulted in more emissions, and or damaging community elements in the vicinity of the project. So they might have a mitigation approach that's more well-rounded because the headlines could be targeting every aspect of the project. And then when you look at the community aspects, the NGO partner who might be more vocal for them would see their risk, the outcome of the communities and with the fire risk event is that they would lose their homes and livelihoods from such a fire. So mitigation from this perspective would look like involving the communities and education and having support that extends beyond the financial asset itself. Mm-hmm. And I think what the real important takeaway from this is that when we talk about risk, we really consider not only the risk event, but the outcome of that event in meeting these different objectives and understanding what those different objectives are for the different participants. So whether you're an off-taker, an investor, or a community, we need to consider the whole picture in order to have a risk-reduced project.
Mm-hmm. Very good. Thank you. I would like to ask one question specifically on the monitoring, because we are launching a product on this, and we've seen some market uptake before, actually, people asking us for that. How do you see that structured monitoring specifically after the investment has taken place? Is that something that is important, should be handled in a specific way? Maybe also a question to David, because that's something that banks are typically quite experienced in, especially in loan books, how to manage those.
Yes, and of course, again, making the comparison with renewable energy projects, right? So the nice thing, of course, if you talk about carbon, then there are already guidance or standards set by the registry, right, for what to report on the what's the MRV going to look like. I think that's your basis, but I think it's important when you start the project or make the investment with the different stakeholders to get together and with the project developer, and to really be clear on what it is you want to see in these reports, right? Because if you look in renewable energy, you could have 10 banks in a syndication, and they all want to see something different, which is a nightmare from the prospect of a project developer, right? So, and they want it in different formats, and they want to do different, like, maybe even different currencies and everything. So it's really important to, at the start of and I'm looking at it from the banking perspective, right? So when you reach your financial close, not just to say in your term sheet, oh, we want to have, an ESG report or a performance report, but to really button it down to say, okay, what is it exactly that we all want to see? What's the format? What's the frequency? And I think that really it also reduces your risk, right? Because then you really agree, okay, what are the things that we really want to see, and making sure, of course, that it coincides with the registry, with the standard. And it's also going to save a lot of time and headache on the side of the developer, because you want them to spend their time on building the project and managing it. And of course, reporting out is essential part of that, but not to overcomplicate matters for them.
Yeah, very good. Another related one on risk culture. How do you see that? You are doing a project, something goes wrong in the field. What do you do? Do you report it? Do you seek conversation with the investor, or do you rather try to fix it without going into it?
That's a question to me, Tim.
You could answer.
Well,
Yeah.
I'm happy to take the first step at it. So I think it really depends also how you hear about this. If this is something that you get through the media, that's terrible, because then you're way too late. But if it's something that your project developer picks up the phone and say, hey, we have an issue here, something happens, that is the way how you want to work in a project. And I think you mentioned sometime before we had another call, Tim, that this is about a culture of trust as well. And it sounds maybe a bit soft, right? But I think building this culture of trust with the project proponents, with the project partners, I think that's the key requirement for people will reach out to you and pick up the phone or send you an email or whatever if things go wrong. And of course, there are always issues, and there are always things that arise. And I'll give you one little example, and then I'll leave it up to you. But we in a solar project, we found out that there was actually a fire that took place, and we were not notified because there was a downturn in the kilowatt hours produced. And then we started investigating. We looked at the report. Hey, kilowatt hours are down, and then we found out there was actually a fire in the transmitter. And so this was not that's not the way how you want to work together, right? So that's really there was one of these syndicated loans, 10 different investors in there, and all they did sending us reports on the kilowatt hours. So I think it's about the culture of trust to pick up these trouble signs very early on.
Yeah. Very good. Chris, you want to
comment? Can I just add to that?
Yeah,
I think it's there can be a misconception that, again, maybe going back to this comparing of a renewable energy or a large sort of infrastructure project to a community-based nature carbon activity. It's not possible that you're going to have a landscape scale activity with thousands or tens of thousands of humans, where something is going to go wrong at some point, right? It's just this is real life. So absolutely, that culture of trust, and that trust goes, I think, towards the sort of wider community as well, the media landscape, the policymakers, right? I think we have a culture of sort of latching on to a perceived problem in a landscape, and then saying, well, look at what happened in this instance. Something went wrong, therefore that project has failed, therefore carbon markets don't work. And we see that's sort of like the thesis of a lot of articles, which is extremely limited in its view, and doesn't allow for the complexity of real life. So we're actively, very actively trying to change that narrative in lots of different ways. But I think it does start with sort of that sort of extreme transparency on how things are going, and just talking about all aspects, the good and the not so good in projects.
Shauna, anything to add from you? We are at about time, so
yeah, I'll be quick, and I might just add. And first of all, I think this is a very important question, probably one of the most important questions. And I think we need to ask, report to who, right? Because there are some things that are meant for some stakeholders in a project, and some that are meant for others, and some, do you know what I mean? So again, if it's something small that the team can handle on the ground and there's not going to be wider repercussions, then we rely on that trust. If it's something that needs to be elevated, it needs to be elevated. But then going back to what Chris said as well, we have to be cognizant of the environment that we're in, where we're put under, the spotlight, and often not in the best way. And these negative stories outweigh the good stories. And so we have to be sure that the right information is getting to the right people and handled in the right way, because some people just don't understand the complexity of the project and they're just too quick to, put the project down.
Yeah. Thank you very much. Apologies to the ones that are there are still some questions left, not too many, fortunately, but thanks to all of you, and we'll cover a green value at risk in the next webinar, and other topics as well. There was something on timing, but I don't want to open that because our time is at the end. So I want to thank Shauna, I want to thank David, and I want to thank Chris for being here with us today, Ling for organizing, and wish you all a good afternoon or a good continuation of the day if you're in the US as Chris is. So see you all at the next opportunities. We're at CIFB in London next week. So maybe there, otherwise see you in other instances online or in real life. Thank you very much, or in a forest near you. Thank you very much and have a good time. Thanks for joining.
Thank you.
Thank you, Sam.